What distinguishes those who make a lot of money from those who never have enough? Have you ever considered what makes one person earn $200K while another earns $20K doing nearly the same thing? The wage disparity is not solely due to the job, it is all about the person doing it and their level of expertise. If you rethink how you do what you do, your yearly income can become your monthly income. Hey guys, welcome back to our channel. Thank you for joining us today. Today we will be speaking about converting your annual income into monthly income. Stick to the end and watch the entire video to get all the details. Also, remember to like, share, subscribe, and click the bell notification. Alright then, let's get started. The value of income earned during a financial year is called annual income. Gross annual income refers to all earnings before any deductions are made, whereas net annual income is the amount left after all deductions are made. The concept can be extended to individuals and businesses in preparing annual tax returns. When an employer makes you a job proposition that includes an annual salary, the sum can appear to be quite large. However, you will not receive your annual salary in one lump sum. Furthermore, it is far more practical to think of your income in monthly rather than in yearly earnings when budgeting. As a result, you'll need to convert your annual salary into a monthly salary to create a budget for your earnings. You can easily convert your hourly, daily, weekly, monthly income to an annual figure using some simple formulas. To convert to annual earnings, multiply the hourly rate by 2,000. Every day, multiply by 20. Multiply by 50 once a week. Multiply by 12 once a month. Let's go over calculating the annual figure with a simple example. Let's assume that Sally's hourly wage is $25. What is her annual salary if she works 8 hours a day, 5 days a week, and 50 weeks a year? The answer is hourly. Divide $25 by 2,000 working hours per year. 8 hours times 5 days per week times 50 weeks per year. Daily, divide 200 by the number of working days in a year. 5 days per week times 50 weeks per year. Weekly, multiply 1,000 by 50 working weeks per year. Monthly, take $4,167 per month and divide it by 12 months per year. If your job offer specifies an annual salary, but you'll be paid monthly, divide your annual salary by 12 to determine your monthly salary. For instance, if your annual salary is $72,000, divide $72,000 by 12 to get $6,000 per month. If your new annual salary is $50,000 instead, divide $50,000 by 12 to get your monthly salary of $4,500. Just because you calculate your monthly salary does not mean you can create a budget that uses every penny. Instead, it would be best to consider taxes and other deductions from your paycheck. For example, instead of your employer paying the entire amount, you may be required to pay a portion of your health insurance or dental insurance premiums. While you may dislike having any deductions taken from your paycheck, it is better for tax purposes if your employer takes them and you pay them with a pre-tax dollar. As a result, those funds are not included in your taxable income. Contributions to a retirement plan, such as a 401k, can also be made before your paycheck is calculated. Your employer would withhold taxes from your paycheck in addition to payroll deductions. These include various taxes. The amount of federal income taxes withheld is determined by your income level, filing status, and the number of allowances claimed. State tax withholding is similar, but it is determined by your residence and the state income's tax rates. If you did not have enough withheld during the year, you would be required to pay the difference, plus any application interest and penalties when you file your tax return. Once you've calculated all your payroll deductions, you'll know exactly how much money you'll bring home each month. Salary and bonus payments are always subject to taxes. Your salary is considered regular pay, whereas your bonus is considered supplemental pay. Both are subject to different tax rules. For instance, the pay method determines federal income tax withholdings on bonuses. Your bonus may be subject to a higher tax rate than your salary, depending on the circumstances. If your salary and bonus are separate, your employer may withhold 25% federal income tax from the bonus as of 2015. This method is also available if your employer withheld federal income from your pay in the current or previous year. If this does not occur, the IRS has a more complicated method for calculating withholding. In this case, your employer first determines your salary for the current or previous year, and calculates withholding based on that amount. The system then adds your salary and bonuses and calculates withholding based on federal withholding tables. Finally, your employer deducts the differences between the tax amount for your salary and the total withholding for your salary and bonuses from your bonus. Aside from bonuses, other supplemental wages include severance pay, overtime pay, commissions, back pay, and accumulated sick leave pay. If your total additional wages for the year exceed $1 million, your employer is required to withhold 39.6% federal income tax on the excess amount. Bonus taxes can eat up a significant portion of your earnings. Some employers attempt to assist employees by reducing withholdings. For example, if your employer offers you a bonus, accepting the raise may lower taxes. Some employers pay the entire tax bill so that employees can receive the full bonus amount. If you work in a nonprofit, you may be able to contribute to a 403(b) plan to save for retirement. These plans allow you to invest in annuities and mutual funds in a tax-advantaged account. Furthermore, the funds contributed to the account are pre-tax dollars. Contributions to your 403(b) plan are deducted directly from your paycheck, so the money is transferred directly into your account rather than being paid to you and then transferred to your account. For example, if your monthly payment is $2,800, but you chose to contribute $200 to your 403 plan, the $200 is deducted, reducing your monthly payments to $2,600. Because your income tax withholding is based on $2,600 rather than $2,800, your take-home pay will be reduced by less than $200. As for traditional IRA contributions, you could claim a tax deduction for 403(b) plan contributions on your income taxes because your company already calculates the deduction. This adjustment will be reflected on your W-2 form, which you will receive at the end of the year and show your total income. For instance, if you contribute $3,000 and your total income for the year is $45,000, your W-2 form will only show $42,000 as your total income. The amount of income taxes you deserve is unaffected by whether you contribute to a traditional IRA or a 403(b) plan. Only the reporting is affected. For instance, if you earn $40,000 per year and contribute $4,000 to a 403(b) plan, your W-2 form will only show $36,000 in income, requiring you to report only $36,000 on your taxes. Instead of investing the $4,000 in a traditional IRA, your W-2 form would show $40,000 in income, but you could claim a $4,000 deduction, reducing your total taxable income to $36,000. The amount of income subject to federal income taxes is less than the amount subject to these payroll taxes. Whew, that's a lot of numbers. Well, according to Bob Proctor, 3 factors determine your earning capacity: the importance of what you do, your ability to carry it out, how difficult it is to replace you. It simply simplifies things. Something is incorrect with at least one of the 3 if you are not earning much money. The central part of Proctor's 3 factors that influences how much money you earn is the one he emphasizes the most. That is because it is the one over which you have significant control. The ability to do your job is more than just a skill. It is also in terms of perceived ability. For example, celebrity chefs on television are not always the best in terms of skill. If the rating is based on skill, they may not even be in the top 10%. However, they are in high demand because they have effectively used the media to promote their personality. So there is actual competence and perceived competence. As important as competence is, public perception is much more important because your ability is useless if no one knows about it. Rich people do not work. They have a variety of sources of income. They are receiving funds from a variety of sources. You can generate income in any industry. The only requirement is that you decide to have this work for you. Don't even consider getting a better job if you want to turn your yearly income into a monthly income. Instead, consider developing systems that will continually generate income for you. Ultimately, you can convert your annual income into monthly income. All it takes is for your decision and your commitment to that decision. Determine your true needs, improve your skills, promote your personality, Bring a lot of energy to your workplace. Set up systems that generate income while you sleep. Expand your capacity for more. Also, don't give up on your big dreams. Cheers. Well, that's all we have for today. If you enjoyed today's video, don't forget to like, share, and subscribe.